Welcome to This Explainer. Today, we are embarking on a journey that literally has the power to completely change your financial trajectory. Seriously, if you're sitting on some extra cash right now and asking yourself, how do I invest this and actually make it grow? You are in the exact right place. Look, I get it. For a beginner, the financial world can feel incredibly overwhelming. There are endless choices, and honestly, half the terminology sounds like a completely foreign language. But today, we're going to break all of that down. We are going to transform you from an intimidated beginner into a confident long-term investor. By the end of our time together, you'll be fully equipped with the knowledge to make your very first investment, and more importantly, you'll know how to keep investing for the rest of your life. To get us there, we're going to follow a really simple 5-step roadmap today. First, why you absolutely must invest. Second, demystifying stocks and ETFs. Third, the best time to start. Fourth, crafting your investment strategy. And finally, buying your very first share. Section 1, Why You Must Invest. Okay, let's dive into this. We often think of keeping cash safe and sound in a checking account as the smartest move, right? But there's actually an invisible threat to our money. That invisible threat is inflation. The U.S. Federal Reserve actually targets a 2 to 3% inflation rate every single year, just to keep the economy moving. But what does that actually mean for you and me? Well, let's look at a highly relatable example. Let's call it the burrito index. Just 6 years ago, a standard Chipotle burrito cost you about $8.50. Today, that exact same burrito is closer to $12. Your cash sitting in the bank didn't shrink in its actual numbers, but its purchasing power actively got eaten away. So, this crucial point is really driven home when we look at this number right here, $1,700. If you had a $50,000 salary in cash back in 2019, you could have bought roughly 5,882 burritos. But today, because of that inflation, that identical $50,000 can only buy you 4,166 burritos. That is 1,700 fewer burritos for the exact same amount of money. Now, while that's a slightly funny example, the underlying reality is really serious. If your money is just sitting there doing nothing, you are quietly becoming less wealthy every single day. We literally have to invest just to beat inflation. But hey, we don't just want to survive here, we want to thrive. You know that old phrase, it takes money to make money? Well, this is entirely due to the absolute magic of compound interest. Let's say you invest $1,000 and get a hypothetical 10% return. After year 1, you make $100. Okay, nice, but not exactly life-changing. But watch what happens in year 2. You now earn 10% on $1,100, giving you $1,210. Fast forward to year 20. That single $1,000 investment, without you adding another dime, effortlessly compounds into over $6,700. Your money's out there doing all the heavy lifting for you. Section 2. Demystifying stocks and ETFs. So, if we know we need to beat inflation and capture that amazing compound growth, what's the best vehicle for that? Where exactly do we put that money? You could choose real estate or gold, maybe even art. But we want highly accessible, predictable, and liquid vehicles. And that leads us straight to the stock market. When we buy a stock, we're basically buying a tiny little slice of a company. But looking at the data, we don't just want random companies. We want the S&P 500. This is a collection of the top 500 companies in the entire United States. Historically, over the past 80 years or so, the stock market as a whole returns about 8 to 10% per year over the long term. Just to put that into perspective for you, if you had invested $100 into the entire stock market back in 1980, it would be worth over $17,000 today. Even when you adjust for inflation, your money would have gone up in value 44 times over. That is huge. Now, you might be wondering, okay, how do I invest in all 500 of those companies? Do I really have to go and buy them one by one? Thankfully, no way. And this brings us to a crucial piece of financial jargon you absolutely need to know, the index fund. Unlike traditional mutual funds where you pay some high-priced manager a massive fee to try and guess which individual stocks will win, an index fund has 0 active managers. It simply and automatically tracks a stock index, like the S&P 500. By purchasing one single index fund, your money is instantly spread across all 500 top companies. We're talking Apple, NVIDIA, Microsoft, the whole shebang. This gives you instant diversification and dramatically lower fees. It's basically a simple set-and-forget alternative to the massive risk of trying to pick one winning stock, like, buying Intel at its absolute peak back in the year 2000 and never recovering your money. So to actually buy an index fund or any stock, you just need to know its ticker symbol. Think of a ticker symbol exactly like an airport code. If you want to fly to New York's Kennedy Airport, you look for JFK, right? If you're flying to London Heathrow, you look up LHR. The stock market works the exact same way. If you want to buy Apple, you search for the ticker AAPL. If you want to buy the Vanguard S&P 500 Index Fund, you search for its airport code VOO. It really is that straightforward. Section 3. The best time to start and the hidden dangers of trying to time the market. Honestly, this is the section that stops so many beginners dead in their tracks. You have the knowledge now, you know what to buy, but you are frozen, wondering, is now really the best time to start? Isn't the market kind of too high right now? I absolutely love this quote from financial data expert Nick Maggiulli. He says, rather than worry about whether now is the right time to buy, just keep buying. Market high or market low, just keep buying. Here is a fascinating fact for you. The S&P 500 spends about 8.3% of all its trading days at all-time record highs. And historically, new all-time highs are usually followed by, well, even more all-time highs. While it naturally creates this psychological resistance to pay a price no one has ever paid before, the data clearly shows that over 20 or 30-year periods, stock returns generally converge positively, regardless of the exact day you started. And this brilliantly illustrates why trying to perfectly time the market will almost always destroy your wealth. Let's look at this devastating data covering the past 30 years. If you got scared, pulled your money out, and missed just the 10 best trading days in a 30-year span, you would erase 54% of your total gains. Poof, gone. Missing just 30 days over 3 decades results in an 83% loss of your total potential gains. You have to be in the market consistently to capture those big upswings. Section 4. Crafting your investment strategy. Okay, now that we aren't afraid of the timing, let's talk about how to actually invest. So if we agree that timing the market is a total fool's errand, how do we actually put our cash into these accounts? When you're ready to fund your account, you generally have 2 main options: lump sum investing or dollar cost averaging. Lump sum is basically taking a big chunk of cash and throwing it all into the market on a single Tuesday. Dollar cost averaging, however, is taking that exact same cash and investing a fixed amount at regular intervals, say $1,000 a month for 12 months. Dollar cost averaging is heavily, heavily recommended for beginners. Why? Because it mathematically smooths out your purchase price over time. And honestly, more importantly, it entirely removes the emotional anxiety of accidentally dropping all your money into the market right before prices dip. You set it, you automate it, and you take your emotions completely out of the equation. But remember, personal finance is deeply personal. Your strategy absolutely must match your reality. If you're younger, you have decades ahead of you. You could afford to take way more risk and just ride out the market's inevitable dips because you have a long time horizon to recover. If you're a bit older and you're in retirement, you need a much more conservative strategy because you are going to need to use that cash sooner. And critically, if you're very young or you just don't have a consistent income yet, actually, scratch that. The smartest investment might not be the stock market at all right now. It might be investing in your own skills and education until you secure a steady paycheck. Consistency is the real magic ingredient here. Section 5. Buying your first share. Yes, it is finally time to translate all this theory into real-world action. So how does this work in reality? It boils down to a super simple 4-step plan. Step 1. Open an online brokerage account. You know, before the internet, you had to call a guy in a suit on Wall Street to do this. Today, you just download an app like Robinhood, Fidelity, or Charles Schwab. Step 2. Navigate over to the search bar and type in your desired ticker symbol. Remember our airport codes? Just type in VOO for that Vanguard S&P 500 fund. Step 3. Choose your order type. A market order buys the share immediately at whatever the current price is. A limit order lets you say, hey, I only want to buy this if the price drops to exactly this maximum amount. For most beginners who just want to get in, a market order works totally fine. And finally, step 4, submit your order. Better yet, dive into the app settings and turn on a recurring investment so it automatically buys a little bit every single week or month. Boom, you are officially an investor. And wow, that brings us to the end of our roadmap. We've conquered the financial jargon, we've looked at the hard data, and we've outlined the exact steps to get your money working for you. So as we wrap up, I want to leave you with one final empowering question to chew on. What will your future self thank you for starting today? The math is crystal clear. The tools are sitting right there on your smartphone, and the most important step in long-term wealth building isn't being some financial genius, it's simply getting started. Thank you so much for joining me in this explainer. Keep learning, stay consistent, and I will see you next time.